Hey, good morning. It's 8:01. I'm always a little behind. So I'm happy to be here. Happy it's Friday, of course. Um, my wife wants to know, when are these podcasts going to stop? I don't know. Maybe never. I'm so dedicated to getting the word out. um, Had a big week. Had a good week. Listened to a lot of good podcasts. I tweeted a lot about the podcast. Richard, of course, always. Rob and Niels. I really liked that one, the most recent one. I tweeted that a bit, especially Rob's jokes. Him saying that I was choking on something because of something he was saying. He never saw what I was choking on. And then me falling off a treadmill. Rob's so funny. Very jealous of his comedy and the laughs he gets. And then also Rob, Niels, and Cam Harvey. That was a good one as well. I tweeted that, enjoyed that one, especially the part about the 60-40 rebalancing. That was good. That's a good issue for us to talk about. then, then the big event, the 2 hour plus probably 3 hours, who knows? Top Traders Unplugged, Systematic Investor podcast with the whole crew. That was a lot of fun. I tried to be a gentleman. That's impossible. I wore my Ted Lasso sweatshirt. I just got my Ted Lasso socks in the mail. That should make me act very nice and calm like he does, but no. Um, got really exercised and excited and emotional and passionate about fall targeting and trend following and hunting outliers. And so that was fun. I was all prepared for the Rob versus Jerry match, um, one-on-one versus about volatility targeting. Spent a lot of time preparing, ready to go. Group consensus was, we've heard enough. We don't need to hear that anymore. Probably right. Um, or Rob, didn't want to lose again. I don't know. Who knows? Um, anyway, the rules. Mute your mic if you're not talking. And we will, if you get booted off, something happened technology wise or something. So just you'll get back on and all that's good stuff. So let's someone take over and let me know what's going on in your life these days.
I was ready for that showdown between you and Rob. I just think Rob got scared, Jerry. I think we'd have had him on the floor, pinned him down, and he would have had nowhere to go if we'd discussed that volatility targeting.
It's hard to debate a man who's wearing, I think, antlers or something. Yeah, I think we were supposed to wear a Santa hat or something, and you pulled out your Santa hat, Rich, but it didn't last very long.
No, I was too gutless. But I think Rob could have gone with a red nose with those antlers.
That's good. That's really good.
At the same time, I want to hear the spoilers, but at the same time, I don't want to. I'm anxious for the show to come up.
What's good about the show was that we could see each other, and that has to be the next step for this podcast, where we can see each other, and you can see us actually, and the faces, and the birds flying around. Then we make it live later on, and you can ask questions or complain. That would be fun as well. So we got to beef up our technology and make it more interactive.
Hi to everyone. Very happy, as I always said, and it always very honest when I say that I'm very happy to be here. And I want to say that this idea with the show, it's a brilliant idea. We'll be waiting for it, and I'm absolutely sure that it will be very interesting. It will be very exciting. Thank you.
Yeah, I agree, Oleg. I like these multi-people sort of shows because it certainly spices things up and you get a lot of different sort of points of view. So I tend to like that format. So hopefully Niels does a few more of them next year.
A couple of weeks ago, Jerry sent me a Clubhouse conversation of A16Z, where they talked with, well, with the CEO from Citadel, and it was a conversation in Clubhouse where the people interviewing were talking, the interviewee obviously too, and there were a lot of people on the sidelines just listening. Perhaps that could be a way to make Top Traders Unplugged more interactive. I don't know, just an idea.
Anyways, I think the Top Trader Unplugged, for me personally, thought of people in the road, it's a great project, and I don't know any analogies of this. And the greatest part of Top Traders Unplugged, at least for me, is it's the part of Top Traders Unplugged that is called Systematic Investor Shows, where it's systematic knowledge of trend following. And it was, I have said before that it was a miracle for me to find this, because I did it before this, before I have found this. It was only for me, I trusted only my research because I saw a lot of different information, and I trusted only my research, and I trusted only trend following philosophy, which I didn't know in full version, but that part of trend following philosophy that I knew, it was enough, and I trusted it, and I did a lot of research, but not only trend following research in different direction, different styles of trading, different strategies, mean reversion, and so on and so forth. But when I have found Top Traders and Systematic Investor shows, it made me a professional trader, and it made me a happy person, and it made my dreams to come true. So it's a great project.
I agree, Oleg. I think kudos to Niels for that Top Traders Unplugged. And what's exciting about it is it's going from strength to strength. So it sort of is becoming a repository or a one-stop shop for all things trend following, particularly classic trend following. And, as far as a dedicated channel for our cause, our particular classic trend following cause, I don't think there's any other. I used to listen to a lot of the, Better Systems Trader and Chat with Traders, which were great podcasts, but they certainly expanded the net to a far broader class of different trading models. But Neil certainly has stuck to the guns in this focus, particularly towards classic trend following. The global macro is interesting and stuff like that, but really when it comes down to it, when you look at his content, there is so much that is helpful for ourselves. And I've been going back over the old series because I'm tending to draw on that in a lot of the writing I'm doing. Lots of different perspectives of classic trend followers. Jerry's. It's interesting when I look at Jerry's recordings over the history of Top Traders Unplugged. The level of consistency there, Jerry, I'm just amazed because you certainly don't contradict yourself. It's been consistent right throughout. So that's I'd like to ask, how do you maintain this consistency?
Great words about this, and great podcast. As I have said before, consistency, yes, because I remember that one Christian monk, which I know, Greek from Greek Orthodox Church. I don't know on what topic he was talking with one woman, but he said that knowledge. I heard his phrase, knowledge is always a system, and I appreciate this because there are no true knowledge, without a systematic knowledge, and it's a piece of knowledge without. And Niels and Jerry and Maritz did this systematic knowledge for the people, and I think there is no analogies in the world, and maybe it's like when a good driver of a president of the United States, or maybe Russia, or Finland, or Japan, a driver of a president, teach how to drive a car in a good way. He teach his secrets, and it's brilliant. And the other guy, who is academic, teach why car is going on the road. Why we have ability to drive a car. He talk about the different gravitation of the Earth and different formulas, and it may be interesting to listen, but no practical sense in this. So listening, only listening top traders and luck. I mean, systematic investor shows. I mean only this here because it's systematic really, and can make a person who has a desire like me. I had a very big desire because I understood before that I loved trading. I understood that maybe it will take 10 years, maybe 15 years, maybe 20 years, even so, only to get the knowledge. And it was my dream. And only when I have discovered for me systematic investor, I start get a habit to listen it every day, near one episode a day, or at least 1 hour a day. And maybe I began to do this in 2019, in December 2019, and in a few months I get so much knowledge, and I did my notes after each episode, and I get so much knowledge, and that it was incredible. It was an amazing result. So I'm impressed with this, and I think there is no analogies in the world. So we can listen a lot of interviews, but there is no consistent, systematic knowledge in a lot of other resources. And with books, I was afraid of reading the books on this topic or listening a lot of something. I trust only Ray Dalio, but I don't know the whole conception of history, but I like his idea of diversification. I like the idea of uncorrelated return streams. Maybe it was, but there is no such knowledge resource in Ray Dalio interviews. Not much, at least. But Niels did a very big. Did Jerry, Niels, and Maritz, they did a very big project, a great project, and I think even in 100 years or 200 years, this project also will be great. And we call this classical, like there are musician classicals, classicals writers, and year will pass and it will be greater and greater. I sure.
100, 200 years, that's that's long term, all right. Um, I like to be consistent, of course, but I think I'm more consistent in my talking than I am in my trading. I, it's easy to kind of be consistent if you're going to fall in love with classic trend following and pay attention to sample size. I feel like that I have like 5 topics or 10 topics. I just keep bringing them up. I keep tweeting about them when other people get close to something that is one of my issues that I really feel strongly about. So it's limiting my vision to trend following and diversification and more classic trend following. And it really is not that difficult to get off track. And then, I have advocated things on these podcasts that I later recanted. And so that's helpful too. You have to recant. And, I like to copy other people. And one way that I've copied other people is as soon as they hammer my argument, I immediately change. And, I've been on this podcast and I've admitted that, you helped me refocus on hunting outliers. And then that was sort of the bottom line. So I had to get refocused on that. And then in another conversation we had, someone was saying, like, Jerry, you really should reevaluate and trade these short-term interest rates. And I was like, yeah, he's 100% right. And so if I didn't admit it then and there, I definitely changed, added back those short-term interest rates, and they've been pretty good markets this year. Immediately, I just added them back. So as stuck in the mud as I am on some topics, which I'm not going to change. Rob's not going to change on vol targeting. I'm not going to change. Um, I did figure out a little way to put it in almost unbeatable comment I made to Rob one day about vol targeting and things like that. But also, you have to be willing to change at a moment's notice. If you're going to rely upon philosophy and building blocks of what makes trading and trend following right and true, then when you find yourself possibly violating the spirit and of those of those commandments, the 10 commandments of trend following or 20 or whatever it is, you must change and you must come clean. And I will do that in a heartbeat. And so I'm extremely hard-headed and then extremely willing to change intellectually. Um, I took stock indexes off my I stopped trading them for a while. And my friends at Chesapeake were telling me we should trade these because other CTAs trade them. And I was like, hell no, I'm not going to trade them because other managed futures people trade stock indices. No. But then later in a discussion with Richard, we were talking about um, stock indices, and maybe on the short side, they can get kind of crazy and the stocks can go to one and you can get these big downtrends. And so with that intellectual argument, I was willing to change right then and there. Um, and so if my friends had have worded it correctly, philosophically, or theoretically, then I would have changed, 2 years earlier rather than just recently. So that's another thing too, is that um, I'm always trying to find these ways to appeal to other people's senses like that in more of a theoretical, philosophical way. And then I've often said, but I live in the real world too. You're in the real world. I feel the same pressures. I don't always stick by what I believe. I take profits when the ATR has gone up by 10 times, or I've got a huge monster profit. I'll succumb and be a human and maybe take some off, but I'm just not. I know it's not going to work out better in the long run.
And about, I want to say about the stock indices, and I said this before, maybe maybe two, yes, not 3 months ago, 2 months ago. I said that I have an idea, and I think that maybe Richard and Jerry will not be very glad with this, but I think if all, like Jerry said just now, if all goes to one, it's my personal thinking way of thinking. If all goes to one, if we have a crisis environment, why not to close all our individual stocks? I mean, stocks that are components of SP 500. Close all this and trade only SP 500. While we have we are looking while we see this environment, crisis environment like 2020. It's for me personally, maybe it's not the best idea, I don't even know, but for me personally it's it's less complex for me to, in such situation, to have only one instrument to and it's I think it's less complex in a crisis environment, in a stressful environment. Maybe I'm wrong, but in fact, we really see in crisis, it's very high. All financials in all crises begin to be very high correlated assets, very high. And like Neil said, I'm very thankful for Niels and Jerry for that about, and I have said before, and will say many times, I'm sure, about commodities, because commodities is great to trade commodities. It's a very great diversification. It's real uncorrelated return streams. And like Neil said, in all crises that we have seen, commodities have done the best performance. And this crisis, crisis 2020, is not exception here. and so it's another point. But so of course, I mean that if it's a very stupid idea to trade a commodities index in such way. It's stupid. But when we are talking about stocks and we see something like Crisis 2020, I think for me personally it will be less complex to create only SP500, while this crisis environment, like I said a few minutes ago, while I can replace this environment.
Yeah, look, the only problem, I actually don't mind highly correlated instruments, provided there's a proviso here, provided we have some mechanism to rectify this short-term convexity weakness we've got in our models. Because if we've got our medium-term and long-term models, we find that with these highly correlated markets like stocks, for instance, if they go short, provided that that trend continues, this is where we make this amazing sort of bounty from the positive correlation being beneficial to us. So it's this weakness. And look, I'm working on a project at the moment, which is not using options. It's actually using trend following models, but it's using longer term signals, but then trading more on a smaller term time frame, just to see if this research project delivers sufficient convexity to give me this protection that is a bit weak at the moment. With I know, we've talked with Jerry and things, and he says, look, this is just what it is. Black Friday was just what it is. It's a blip when you really look at it, but I do feel as though we are a tiny bit exposed there. But anyway, look, I just wanted to change the conversation a bit because I was listening to Mike Ivey. Jerry gave us the video to Mike about Mike's presentation on Chesapeake Capital. And I was just wondering, Jerry, does Mike see everything the same way as you do, or do you have sort of robust discussions and different points of view, or do you find that you both are incredibly aligned in your philosophy?
Yeah, that's a good question. I was listening to Mike as well, thinking, wait a second, it sounds a lot like me. The thing of it is, I just had a conversation with Mike, and it revolved around a lot of the things I've been thinking about recently and talking on the podcast and on Clubhouse. So I think he got a pep talk, and he was really excited to hear all of that. But it was remarkable. For over 30 years, we have worked together, and we started agreeing philosophically on all of these different issues. And it was back and forth. I was the philosophical person, and he was the math and computer person who could put it all together and and create the systems. And we just made sure that we did not want to disagree with each other. We just worked on issues and projects until we came to an agreement, and it wasn't hard. Because he introduced me probably to hammering on this idea of trade stats, not trusting the back test so much as it relates to the equity curve, and then he was also not on the line every day watching performance, dealing with clients. So he was a calming influence. I remember we had some sort of really bad day. It was a real bad stock sell-off day. They have a name for it when the stocks just got crushed one day. It was the brief. I forgot what the name of it is, but it was the brief monstrous sell-off. And I was like, Mike, what's going on? What do you think? And he's like, well, it just depends on if you believe in these systems and you trust these systems. And so he was able to go back down to his office and shut the door, and I had to sort of like deal with it. And but that really is the issue. And so we've taught each other a lot and having each other's back, and putting it was really helpful. We ran into situations and issues where we were over optimized and lost our way, lost our way from the classic trend following, but we got it back. And yeah, I mean, He's really a solid guy and knows what he's doing. He's got a lot of talent. So it's been, fun 30 some years. And it's just a miracle to run across someone like that and kind of grow up with them and build something that we built. But yeah, it was really, really good to hear him. And we would leave meetings sometimes. He and I would go into these meetings with clients and we would just start talking, saying some of the same things you hear me say all the time. And then after the meeting, we'd say, damn, we are good. I mean, we are amazing. What we believe is so solid. If it wasn't, we would fix it and we would think of it and we would answer it. We would be able to answer the questions. Sometimes the answers are not great. We're going to lose money. We're going to play for the highest expectation and the best performance, and we're going to try to preserve capital, but we're not going to worry about some of this volatility, especially as relates to volatility and open profits. And like, I don't think too many people agreed with us. They just liked our passion and our commitment.
I like this trend following idea so much, and I think it's very important. So it can be applied to almost a lot of almost all aspects of our everyday life. I think it's so great when you preserve your capital, and when it's crisis environment, not lose much, only not lose and wait, and do the right thing and do the hard thing, and the and it will change, and it will be profit, and we must also be calm when we are in profit, because when I learned maybe 5-6 years ago um, to handle the pressure of a drawdown, I could not handle the pressure of profit, because when I was in a drawdown it was okay, but it was a profit. I wanted to close this too early, because I saw it's like psychological things. It's like people afraid of planes, because plane in the air, but technically plane is very safe. And if we take something like a cup, and will it will fall down from our hands, and it will broken because it's gravitation, of course. But plane is not a cup. So, when we have a very good, I mean this to be clear, that when we have a very good technical solution or strategic solution, like we have in a transform, like we have in a plane, so that plane is really safe. If we look how it works, really, if we understand how it works, it's really safe. And the statistical, I looked through the statistical of catastrophes of planes, and it was because of pilots. Most of all, it was not much catastrophe in the roads for the recent last 20 years. Not much, maybe 100, near 100, and most of this things was because of mistakes of pilots. So here we can see some analogy maybe, because trend following organized in a very safe and good way, but it cannot look be safe. But in fact, it's safe, and we must understand, and we must handle all this pressure. We always talk about this, but it's very important to talk about this again and again. We must handle not only the pressure of drawdown, but the pressure of the profit. And I had a lot of my research, and my recipe for this is two points. First of all, it's research, a lot of research, and listening to the best expert like Jerry and Niels. Listen to the best experts and do your own research. 2 points here.
Yeah, and one of the things I mentioned earlier was this idea that the Cam Harvey. Cam Harvey's a famous professor, I guess, and he's does research papers and books, and I've read some of his stuff, and he was on with Rob and Niels on a podcast, and recently, and thinking of talking about a book. And anyways, I liked one of the things he was saying about the 60-40 rebalancing. So I'm listening to this, and I think I've on Twitter read some stuff from different people about rebalancing and rebalancing premium and whatever. And most of the people I can't really get into what they write or they say, but he sort of like said, we did this research and it basically 60-40 rebalancing is a tremendously bad idea. And I'm like, okay. And he's like, yeah, because here's what happens. You are buying equities when they're going down, and then you're selling them when they're going up. And he goes, it's anti-momentum, it's anti-trend following, so it's bad. And I'm thinking, oh yeah, I should have responded to that, and assumed that historically, when I've heard other people talk about it, I should have said, of course, I don't have to even do this research. I know that rebalancing and buying something when it's going down, it's not going to work out. It will work out sometime, but then you're going to get caught on the wrong side of these massive outliers, these massive moves. And so I was a little disappointed in myself with not reflexively knowing that this traditional 60-40, when stocks go down and now your stocks are not 60%, and you have to buy more to get them back up to 60%, it's not going to work. And so people are writing these books and they're writing these papers, and they're stumbling onto this amazing insight that, oh yeah, it's anti-trend, so it's not going to work very well. So I thought that was pretty funny, um, in that, because one of my goals, is to be very bold, and is to be this ambassador and be the person who's kind of there, um, holding the flag for trend following in stocks or in the traditional world. And yeah, I need to be more bold. Yeah, louder. No, no. I was too loud. I was too um, passionate on that top traders thing with all of us. But I was trying to behave, but it was very difficult.
About 60/40 portfolio, I want to say that Nils a lot said a lot of times that it's very, very bad thing, and I appreciate this for these ideas, because 60/40 people think that it's safe, but Nils said that there was research then only in 20th centuries 7 times, it was 7 periods, only in 100 years, 7 periods where 60/40 portfolios did not work. It will not be working, and it's only a matter of time. Maybe in 5 years it will stop working, maybe in 3 years, maybe in 10 years. And I totally agree with this, because Niels said that even from 1900 to 1920, it would it not worked at all. 20 years, 60/40 portfolio did not work. And the same I can say about Niels said, to be honest, said about stocks. People like stocks, but like Mark Jabrzinski said, I like his word that people's opinion change very fast. Very fast, people opinion. So they like stocks because they have good results for a few previous years. But sooner or later it will stop doing this, and I'm sure. And we have seen this in a history. We see the evidence of this. We see a lot of history evidence about stocks. Niels said that for 16 years, stocks, in fact, didn't perform at all. Buy and hold strategy. So people do what is psychologically comfort for them, and I think so. It's like I said before. In fact, I'm sure that flying on the plane, it's much safer than driving a car, much safer. And if we see the evidence, if we do an analysis how the plane construction and a car construction and a lot of different things, there is another cars on the road. There is a lot of many factors, a lot of risk factors, and in the plane there are not so much risk factors. But people are afraid of a lot of people, not all, of course, but some people afraid of planes, but don't afraid of car. Things there's something similar here. People like stocks. I agree when people like real estate.
Actually, what fascinated me about Cam Harvey's discussion was that he one of the things that I've got a real concern with is when assumptions are made by industry, such as fixed rebalancing is a way to obtain a rebalancing premium, or they might be talking about methods of smoothing returns with Sharpe. What they're talking about are measures that are applicable to convergent trading strategies. And the problem is that the industry, about 95% of the trading strategies you see being applied by industry are convergent in nature. About 5% are divergent in nature. And when you're dealing with divergent strategies, you cannot blindly take on those assumptions. So the rebalancing premium, this is what I loved about Cam Harvey's book, is that he challenges a lot of these assumptions that we hear, such as the rebalancing premium, saying that fixed rebalancing, so, the typical annual rebalance, so you've got a 60-40 portfolio, for example, at the end of the year or end of each year on a fixed sort of periodic basis, you rebalance your portfolio and re-equilibrate it to a 60-40% mix by basically getting rid of the high performers and picking up on the slack performers. Now, that assumes, embedded in that assumption of that rebalancing premium, is that these markets mean revert. Now, when you're dealing with divergent strategies, the core principle you are looking at is this feature called serial correlation or autocorrelation in the data series. So Cam eloquently argues in his book that you do not periodically at a fixed frequency rebalance your portfolio. You actually monitor the regimes and you strategically rebalance that portfolio if your components of your portfolio have divergent strategies within them. Now, this fits very well in this. You need to dig into the weeds to find out exactly what they're talking about, because there is a lot of nuance here. And if you blindly assume these assumptions that are spouted out by industry, as divergent traders that we are, we're going to fall into these massive traps where we're finding that we're smoothing the volatility curve, we're adopting Sharpe-based measures, we're adopting fixed rebalancing, and it is really destroys the edge that exists in our system. So I think, Jerry, you weren't loud at all at that podcast we had. I think you've got to call out when we think there are things that don't fit with our philosophy. We've got to call them out and understand them, because if we just accept this rhetoric that comes from different quarters to us without understanding the details and how it all comes together, we're not only leading potentially ourselves astray, but we're also leading our listeners astray in adopting methods that are inappropriate for our philosophy. So I totally support you, and I don't think that you are aggressive in any way. I think we've got to do that. We've got to critically assess every statement that's put forward. And what I loved about Cam Harvey is that we've got Rob, and his ideas. I love his ideas, but he has definitely got a convergent flair in his ideas. And I like the fact that he really admires Cam, because Cam was calling out a lot of the assumptions that Rob was making, and I really like that. So when Cam was dealing with Sharpe ratio, he said Sharpe is a hopelessly inept tool in his book, and he says that look at the non-linearity. You must look at all of the factors that we're raising, path dependence, all of these things. And if you take the Sharpe ratio and add on these particular elements that are a must in our divergent world, lo and behold, you get a far better risk metric particularly for our divergent models. So I'm loving the way the discussion's going, and that's why there's a minefield out there, and we've got to stick to our guns and our philosophy and critically assess every statement that's made.
Yeah, and regardless of how you trade, regardless of what you believe, if you're going to be convergent, if you're not going to be trend following, or you have a big issue. You have to deal with these outlier trades, and it's something everyone has to face. How are you going to survive? What are you going to do when you get the outliers? And you can do like we did, which is build an approach that tries to find them. I want them. I'm not hiding from them. I need them. And my whole approach is built around them. But regardless, you can't ignore them. They will run you over. They will destroy you. They're bombs waiting to explode and make your history in your time in trading less than it could be. And it did not. I was getting a lot of joy of posting on Twitter quotes from Cam Harvey because they were, and Rob is sitting like next to him, and I thought that was pretty funny because Cam was my kind of guy when he was doing that
I had the same
interview.
feeling.
Although he does need me to help him understand vol targeting a bit better. I say that jokingly, but um, he he's not an expert. I could help him see some of the big downsides of volatility targeting. And
Yeah,
Rob
look,
tried to.
that
Rob tried
volatility
to.
targeting, what Cam was saying, and look, I agree with Cam in that trend followers, we all do volatility target, but only on the entry condition. Where you and I have our concerns is this volatility targeting, where we're taking a bit of that unrealized profit off the table to smooth our returns. Now, Cam is not agreeing with that. He's saying that volatility targeting is applied by trend following managers because they apply ATR based rules on their entry. So a volatility position sizing statement. So that's what he's referring to in the volatility targeting. And that's why it's a shame the discussion on the podcast with Niels didn't have that battle between you and Rob, because that's where this point would have been raised. You and I have our concern with volatility targeting by sacrificing some of that unrealized profit, which we don't want to touch. That to us is a no-no, but we probably would agree that we do volatility adjust our position sizes based on ATR on entry.
I'd like
Though I
to add to
can't.
that. I'd like to add to that. When you're volatility targeting, what I see is that you get an effect similar to rebalancing, because when you rebalance, what you're doing, you're disallocating money from the asset that performed best to reallocate to something that's performing worse, in hopes of it mean revert. When you're volatility targeting, you're doing basically the same thing. You're taking money away from the trade that's doing good, in which its volatility is expanding, and reallocating that capital to trades that are performing bad, isn't
Exactly,
it?
Bruno. Exactly.
Well, you didn't have the match with Rob, and I can't possibly, be held on that same status. But I'm fully ready for a match today about this, because I thought that Cam Harvey actually had amazing points to explain why vol targeting is very different from rebalancing 60/40, why vol targeting and doing a little bit of management of your revenue streams through gamma monetizing, it's really important and is not at all conflicting with a divergent trend following framework. And it was very interesting at the beginning of his podcast when he was talking about his work, all the work he's done to sort of adapt Markowitz and optimization and all these sharp ratios, so all these very contentions and very, I agree with you, Richard, based on consensus, which is convergent trades, back to and ported to divergent strategies. And he was talking about doing optimization for Sharp, and described the framework that is very, very similar to things that I do. So I think it was really, really good for everybody, seems like, for you guys, because you read it. Oh, this is all a very definitive condemnation of vol targeting, and for us, or for me, because actually it did make very good points about using volatility, taking profits when you have gamma to monetize and things like that. Obviously, everything depends on this huge debate we're having. This philosophy. I like Jerry talked about philosophy. This philosophy, premises differ between us. And so you guys care a lot about outliers and positive skew, and don't want to sacrifice anything for it. Rob and Derek and myself, we are a bit more cavalier about being staunchly wedded to positive and very high skew. When we say, well, if we can trade some of that for a little bit of more stability and controlling the drawdowns as much as possible. Obviously, I don't worry about a 2-3% drawdown. I worry about something else. And so, it's the battleship to take Richard's metaphor, is when Black Friday events happen. How do you monetize around those events? And it feels like, this vol targeting done the right way, which is, by the way, not done by looking at rolling standard deviation and adjusting your realized performance to your target volatility. It's done in a different way. We haven't talked about the details of that because I think I would bore you to death. But there's a big difference between the kind of perceived way of or the sort of narrated way of vol targeting and how most people, how the I don't want to call it more sophisticated, but the more sort of industrialized people do it. And I think Harvey was speaking for some of that.
I think I do need to re-listen to the podcast. And Bruno, by the way, can you at least point me in the direction of papers and material of this different way of measuring volatility?
Yeah. I mean, we have talked about, Derek has talked about some of the metrics. I'll post something. But there's this idea of semi-volatility. There is the idea of non-parametric, so you use quantiles. I've talked about utility functions and having utility functions that are concave on the way down, so with respect to losses, and convex on the way up. So logarithmic with respect to profits and exponential with respect to losses. So you react very fast if you're in a drawdown, but you don't care about when you're making money, you're sort of more tolerant towards drawdowns. There's all sorts of things. The point that I'm trying to demystify, and I think where we have a big confusion, is that vol targeting means tracking a standard deviation and doing Markowitz optimization, naive Markowitz. And then, so let's say you're targeting a 10% volatility, your realized returns are running at 20% volatility. You need to cut your trades in half. That's a stupid way of vol targeting. This is not only destroying your your outliers, because obviously you're taking profits all the time, but is also making your system more fragile. And I agree with all of you. I'm probably even more fierce in my critique of this type of system. But volatility targeting requires a volatility model, which is not standard deviation. So you can look at it in terms of utility functions, in terms of volatility measurement, in terms of optimization, and probably requires continuous signals. So if you're not prepared to breach over the dark side and join us, the bad guys, I think it's going to be difficult for you to sort of create a system that works with your framework, and one entry, one exit, one stop. So that's why I like about Jerry. Jerry is very clear. He says, I care about skew. I don't care about portfolios. You guys are crazy. This correlation, second moment matrices, you just go play with that. Optimizers, not my thing. Standard deviation, volatility, schmolatility, you guys get lost. It's brilliant. On the other hand, there's a bit more, machinery that we can use. I made the analogy on one of the calls that, we're not driving in 60s in cars, that were built in the 60s, but we're doing portfolio manager with Markowitz, and Markowitz machinery, which was amazing, was built in the 60s. So we have to, upgrade our cars, I think, a little bit.
Dark side, I love it. So you're saying that volatility is not restricted to the second moment. Is that right? Is that a right assessment?
No, actually, again, I probably confuse people because I don't like to talk about volatility because people think volatility, it's, so we are talking about volatility is the second moment of a Gaussian distribution. So, I don't want to call it volatility because our returns are not Gaussians.
And that's right,
But
Bruno.
it's a second moment. So, volatility is definitely a second moment. But what I'm saying, instead of talking about correlation, I talk about the second moment matrix, is this object which you derive by measuring the second moment of your distribution, however distribution you want to use. So it can be complicated. And if you think about everything in a Bayesian framework, then you have your priors and your posteriors. So your posteriors are different objects because the posterior is almost always a normal distribution of parameters. So you can talk about variance and volatility of those, but your priors may not be. So it's a bit complicated. I think Derek is doing a great job at teasing out these aspects, and every time we get a bit more technical, we feels like we're making progress. But I actually thought that Cam Harvey was really speaking to a lot of people, not just the traditional classic trend followers. And so I love this podcast.
Yeah, look, I don't think Cam Harvey was directly having a plug at you, Bruno, or Derek, or Rob. He was certainly having a plug at those that adopt a naive posture to this volatility targeting through that simplistic method you're talking about. So that's why in these discussions, when we're talking about volatility targeting, for God's sake, let's use another term if we're discussing what you're talking about, Bruno, in using other forms of distribution, more realistic forms of distribution, then just don't call it volatility targeting, because to me, volatility targeting sits in the camp of sharp, because you need to understand what the definition means, which I do spend a bit of effort doing. And when I find these different flavors of volatility targeting that we're talking about, some of them actually do make a far degree more sense than that naive treatment that the definition basically deals with.
Yeah, no, I'm totally with you, and I love the conversation on our Clubhouse because it's really good. It checks, it forces you to think. I never understood as much about classic trend following, until I started talking to you and Jerry actually. And it's funny because I even my first foray into futures was by trying to implement the turtle model. That tells you how much I understood at the time. But it's great that you guys are so rigorous and so precise in defining the system that can help me think where are the differences. And I totally agree with your way of doing it. I mean, you live in a world of arithmetic returns, where skew is the only thing that's worth optimizing for. And I have absolutely no problem with that. Though I do things slightly differently, and I think I'm trying to follow the leaders of the industry, the Wintons, the AHLs, and all these guys. And those guys, I'm pretty sure. I mean, I don't have direct contact with them, but I'm pretty sure nobody there is actually using Python or pandas and calculating rolling standard deviation and betting billions of dollars on that. I mean, that's not how it's happened, how it's done.
I'm actually a bit less concerned about the Wintons of the world. I think their track record doesn't necessarily speak to, speak to the high level of quant research that the firm does. There are certainly better examples I'd be using. Chesapeake's one of them, of course, and Paul Mulvaney. His model, it hits people in the face with this volatile model, because people think, for God's sake, how can people take this volatility? But when you understand what he's achieving from his risk-adjusted metrics, it just blows me away. And it just makes me think, if you're prepared to have that sort of faith in that philosophy, then it's amazing when you decide to leverage up what we're all talking about, because the sky's the limit. And I of course am much more conservative in nature. I always tone down the volatility. But when you're dealing with our models that have this infinite possible upside, you start questioning things such as, well, over the last 10, 15 years, have we seen a market environment that's simply suppressed our upside potential? What happens in a new future, in a different future, where that upside potential isn't confined? Does this mean that because we have this unlimited upside, that makes me think that at the moment we might be sort of matching or sort of trying to match against our convergent cousins? But in that future possible history where this unlimited infinite potential exists, that's where I have so much faith in our models that we've gone through a lot of the worst conditions. What happens in the best conditions? How much can we actually make from this process?
Yeah, I need to go back and listen to Cam Harvey again too. But I was more in Bruno's camp because, as I said to start this off, I didn't think I was agreeing with him on the vol targeting, and then Rob tried to slip in there that, well, we all do it. We Jerry does it at the entry. Other people do it throughout the trade. But yeah, I don't agree that you should call um, our sizing our positions based upon volatility at the entry. That's not anything close to a constant vol targeting, and that's one of my problems with it. Is it's constant rule, and it is a target, and it's a non-system trade, and it's done like potentially every day, and then you not only reduce positions, but you put positions back on. There has been times like in August of 18, I believe, where the S&P got very low vol. So maybe the original breakout was a year earlier, but then as the market slowed down and the vol got smaller and smaller, they're required to put on more S&P, and the S&P is put on uh, based upon the volatility, which is low, and not just on their AUM. And when the market then crashed, that was the first time the Dow had ever been down 1,000 on the day. Um, they have to unwind these positions. Now the vol is getting bigger, and we just put on these positions, which and once we get the fills back, we have more to do. And so it does create an unstable market. He downplayed how unstable the market can get. And then people who came in, AQR and Dalio, after that, saying, hey, it wasn't us, it wasn't vol targeting, it wasn't um, the whatever that other thing they call stocks and bonds when they kind of vol target that. Because it couldn't be us. Look at our AUM. We don't have enough AUM in these categories. But the problem is they leave out the fact that AUM is just one component. For a CTA, yes, my AUM figures into my um, quantity calculation, but so does my unit size. So does the ATR. And so I can have these crazy outsized positions on because the ATR was low. And my position in Moderna is ridiculously high because when I put it on, the ATR was 87 cents. So this, the smart guys left that part of the equation out. So I'm very skeptical. I think it may have been you. I think it may have been CTAs who started this domino effect and created this big, huge crash. So I do think that vol targeting. I mean, I like to blame almost everything that goes wrong on vol targeting. So my credibility kind of goes down the longer I talk.
I have, as I have told before, I have experiments with ball targeting. It was near 5-6 years ago, in 2016, 2015, and I want to say, and I said before, that if even it is profit, and I had a successful year with ball targeting, 2015. Yeah, it was successful, and half of 2016. But I think it's too complex. Even it is good. Even even it would be a lot of evidence that it's good. It is too complex for me personally to do it, but there is no good evidence that ball targeting will bring you good results in a long term. And I think maybe theoretically it can be, but I don't see the reasons for me personally to do low targeting.
It definitely makes less money and per unit of risk, per the risk in the trade. It forces you to trade larger because you're taking smaller profits, and it's a non-system trade. And then you have to introduce, the only way to get around some of these ideas is you must introduce Sharp into the equation, or something like that into the equation, so you could say, oh, it's risk adjusted returns. That's what we're after, not just returns. And then it reminds me of the articles that I've posted recently about Spitznagel, who sort of says, no, it's all about returns. It's not about Sharp and risk adjusted returns. And then what do? Once you have this system that's not robust, because you're doing so many non-system trades, you leverage it up. No, I will leverage it up because it's more efficient. It has a higher Sharp now, and it's so wobbly. It's not going to. But then once again, I think if you're going to do things like this, I'm going to totally switch my opinion, and that is just do it every now and then, sin infrequently. Um, we all do it. We can all do it. You can't argue. I can't argue that it's a good idea, but I'm going to probably succumb to the pressure anyways. But a daily diet of a bad rule is way worse than every now and then using a bad rule. And of course, bad rules are defined as rules that don't have the trade sample size.
I think that will target all which is against trend following classical philosophy. I think we must be very careful with all this. And for me personally, at least, it's so. And years of research showed me this, that if there is a problem with a trend following, with the philosophy, the basic philosophy, not only when we are speaking about trading, in business also, if something is against business philosophy, we must be careful. And if it can look very good, and some people can want to promote this because they want a lot of attention to themselves, but we must be careful. And I think even if we do a lot of research here, we don't have a lot of sample size. And what is the problem? For me, I don't understand how it can work in a long-term horizon.
Well, it works when it does help you monetize the positive convexity of trend following. So I understand that in your philosophy, like the way you see trend following is hunting for outliers, and sample size is less of a problem. I think what I find difficult to rebuttal is that this idea of outliers, and somehow, I'm still not clear how, but somehow in your process you know that there's outliers there to be captured, and so you have to put on the trade. It doesn't matter whether the outlier comes in you know, many weeks after keeping the position or comes very soon. It doesn't matter whether it comes from asset A, asset B, sector A, sector B. It just doesn't matter. It will come. So in that sense, if you're seeing the portfolio this way, if you're seeing your trading this way, it's difficult to see the benefits of vol targeting. But if instead you move more into the world of, for sure, what Rob looks at, what I look at, what I think Derek looks at, which is a use of capital, an efficient use of capital. I know that Jerry will start, puking at my words now, but efficient in the sense that you have a collection of trades that form a convex object called a portfolio. And you start thinking about this portfolio. And this portfolio has many properties that are explicit and implicit. The explicit properties are obviously how you constructed. I mean, how many asset classes and how many instruments do you track and things like that. But the implicit ones are, how do these positions move together and stick together? So you have to have some sort of way of looking at, guess what, second moments. So second moments are volatility and correlation, or variance and covariance, however you want to call it. And again, it might not be variance and covariance because the returns are Gaussians. But what we talked about, if you remember with Derek about continuous signals, is continuous signals are a way to transform the data into a more Gaussian type of returns, which I believe. So if you link that, you do a transformation, you follow your signaling power, then vol targeting comes into play and helps you monetize in that convexity, monetize in that gamma. Yes, of course, it will reduce skew because there's no free lunch. You have to pay for it. You can't catch a 500 APR because you will monetize it on the way up. But at the same time, you're going to start putting in a tiny position and then scaling it up if it goes your way, or just coming out if it doesn't go your way. So it's not as clear cut as you guys think it is, because yes, it undermines your skew, but you're getting something else in return. And to get something else in return, you need to do two things which you don't do, and so you can't see the benefit because you're not measuring it. The two things you need to do is not accounting for equity in different ways, i.e. open and close, and explicitly measure and monitor your second moments or your correlation. You have to have a matrix that says asset A and asset B in the portfolio behave in a certain way. But if you were to do that, I think you'd see some benefits of vol targeting. That's not to say that you should vol target, but that's, hopefully explains why I'm so, and other people, why we're so enamored or so captured by this approach.
No, look, I understand that, Bruno, but I feel that you've added complexity into your models where we've stripped back to simplicity. So with your continuous signals, if you are catching an outlier, your continuous signals are going to show a very strong trend strength. So your position size is continuously going to increase at the expense of all of your other return streams. So then I can understand why you will be taking some of that profit off the table. So pound for pound, it's almost achieving the same thing as what we do, but with a much simpler model where we just don't address a continuous signal plus profit targeting. What we're saying is we're applying these discrete signals. We might use multiple systems, as I do, which is sort of getting more towards continuous systems, but I'd still argue that it's not. But you are investing heavily in that single trajectory of that outlier through your continuous signal. I say, well, that's not the way outliers work. Outliers, by definition, are unpredictable. So to base your trend strength on a signal where an outlier can be incredibly messy, like the Moderna outlier, where we saw, a significant rise and then a massive drop, but then another significant rise going up. To me, that was one big outlier. It wasn't a combination of different components. That was just how that outlier played out. And so therefore multiple systems under, say, a discrete approach, which are configured differently, could capture many more aspects of that possible outlier, that rugged form of that outlier, than, say, a continuous signal would. Because a continuous signal would be saying, well, it's actually not that strong an outlier because we've had this big retracement. In fact, the continuous signal would look more at a linear progression of an outlier, an exponential function of that outlier, to adopt some form that was quantitatively valid in your model. So I'm saying, no, outliers are much messier than that. We've got to simplify our models rather than make them more complex. Otherwise, we're going to miss out on this potential, juice that's given by these very unpredictable anomalies.
Yeah, I hear all that. It makes perfect sense. Again, I don't want to sell anything to anybody, and I am just trying to explain why we do the things we do. In the context of continuous signals, volatility targeting, there's one aspect that I keep hammering on and people sort of don't pay attention to, but is really important and is exactly what corrects for what you were saying, Richard. So you're saying if Moderna, like, it keeps growing and growing, what are you going to do to your signal? Are you going to scale it to infinity? If you remember when we were talking about transfer functions, I said that at some point you have to cap your signals. So you don't grow it to infinity. So you continue signal goes to max and stops there. You can't do more than that. And the other concept in continuous trading and volatility target is the concept of a ballast. What is a ballast? So if you see markets and prices as being forces that kind of move up and down and displace the course of your battleship, to follow along your metaphor, what happens here is our continuous process and our vol targeting, our optimization always spits out optimal trades to do. But unless they are significantly different than the portfolio you have to have tolerance, and you don't trade all the time. You don't keep paying away costs. So this concept is very important. Yes, we vol target. Yes, we are continuous. Yes, we try to monetize, but exactly to avoid these, if you wish, negative skew aspects, or probably even negative convexity of being too continuous. We temper ourselves. I'm not here, my servers are not firing trades every millisecond. I mean, I trade at the end of the day, like all of you guys, and I don't trade a lot if the market doesn't do a lot. So again, all these things need to be tempered. And as usual, like with alcohol, is best enjoyed with moderation. And I think moderation is an adjective that I need to keep reminding myself about.
Thanks, Bruno. No, I hear you.
Guys, can I ask you a question, Richard? Do you have any kind of quantitative or objective way of knowing or trying to know which markets are more prone to have outliers, which are more more useless because they mean revert, etc.? I was thinking about when Jerry was speaking about the stock indexes trades, and Oleg was talking about the commodity indexes. Do you think there's a way, or just you just select them just thinking out of the jar, so to speak?
Look, I pretty heavily researched the market price over very long data sets. And what I'm finding on all of my liquid market data sets, when we take, say, a 30-year history of all this liquid market data, I'm finding that I can categorically say that every single one of them are a leptokurtic distribution. In other words, they have fat tails. So that tells me that outliers exist in any of these liquid markets. So that's point one. So therefore, I can understand why we might adopt a sort of a posture where we therefore treat all the markets the same. It makes sense. However, what I do find is that the degree of noise and mean reversion in the markets is different. When I look at some of the forex pairs and some other instruments, I do find that there is considerable noise and mean reversion. So what this does to those outliers that exist in those particular markets, it makes them far more messy. Therefore, it makes them far harder to trade. They are still outliers. You can still see the outliers and you can still see that autocorrelation existing, but it's much more fractured. So it's far more difficult for our following models to navigate those very messy markets. So when I do my data mining efforts on that market data, obviously my data mining therefore starts selecting markets that have a cleaner signal. Now, because I've got to I'm in a fortunate position where, as a retail trader, I've got only a small finite capital. I'm certainly nothing like Jerry. Jerry's got the benefit of diversifying extremely widely. And if I had that level of capital, that's exactly what I'd be doing. With small bet sizes, I'd be getting those bet sizes down to as small as possible and not caring less about the noise and mean reversion in the data. However, because I've got finite capital, I do have to make a selection ultimately over which markets I trade and how many systems I apply per trade, simply because I reach my finite limit. Therefore, in my preference, I therefore choose these cleaner markets that my data mining picks up. But I can see where Jerry's coming from. I think it is a more robust way of looking at the markets by treating them all the same. But I do, in my world, have to make that decision. When I've got 1,000 different return streams and I might have to strip it back to 200 return streams to trade, I do need some method of I use the data to tell me which ones I strip back to, as opposed to my brain or my logic trying to say, well, this is because of this. I'd much prefer the data over very large data samples to tell me that story.
Okay, thanks. Because when we're speaking about, for example, commodity equity indexes, the story which kind of makes sense is that all those stocks averaging themselves will make less outliers than taking each of them separately. And I
Yes,
couldn't.
Andre, you're right. You're right. Equity indices is a different kettle of fish to commodity, your individual markets. So equity indices is more like an ETF, and the nature of the outlier changes. So as opposed to your individual markets that might have more of an exponential function in them, the method of an index or an ETF basically dilutes that signal because you've got many more instruments in that collection. It works exactly like a portfolio when you're dealing with an ETF or the S&P 500. That effectively is a portfolio of return streams, and you are getting those correlation offsets occurring in that collection of markets, in that ETF or in that index. And that necessarily does flatten the overall path of the index market price. So there's a long-only bias, tends to be in the indices, and also you get this flattening effect. So the form of outlier tends to form what I call a linear extension of outlier as opposed to an exponential function. It's a different kettle of fish, and you do need to look at that because that's why I think Jerry's in a much safer land going to his individual stocks, because they clearly have those exponential price moves, Moderna, all of those things. But when you're looking at an index, different kettle of fish.
And also, when we see commodity indexes in that way, those are also muted and less prone to outliers because there are much more commodities, and so the outliers clean up themselves.
Exactly, Andre. That's exactly right. I mean, ideally, we'd be trading the markets from a single farm of a corn producer, as opposed to the entire farms of corn producers with a commodity called corn, because you'll find more outliers at the individual operations level than you will at the market level, because the individual operations, they'll have these anomalous events such as droughts, floods, all of these things that impact their business model. There will be outliers in their performance, but they'll be muted when you're looking at a consolidated picture of all those corn farm producers. So that principle just steps up as you go to indices, ETFs, all of that thing. So when we're looking for outliers, we're looking for these anomalous events. They tend to be muted or diluted when you look at larger and larger collections of these things through the principles of this correlation offset, just like our portfolio works.
Out of the box, I would thought that commodity indexes will work better because they are less correlated, and in my mind at least, they are more explosive, so to speak. So an index of commodities would work better. Although it's safe also to say that since they are decorrelated, maybe they don't get big outliers when everything goes to one way.
I
Yeah, I
think that
agree. The degrees, there's degrees.
I'm sorry, but I think that index of commodity not very good idea, because we are talking about commodities index. We are talking about basket of different uncorrelated return streams. For example, corn and oil and bananas, maybe, I don't know. And I think that it's not very good idea. It's really a bad idea to have index of commodities. When we trade commodities, we must trade it only as individual commodities and nothing else. As I said before today, it's okay, maybe it's okay to trade SP 500 for me personally when we have a crisis environment, and to do the situation, to do the trades less complex, I think it's okay. trade on SP500 because it's in a way it all go into in one way in one direction, but commodities prices commodities are the most uncorrelated instruments for me, and to do it as an index is not a good idea.
That makes sense, Oleg.
Yeah, besides, most of the indexes are too energy weighted.
Yeah, ultimately, the choice of ETF is basically determined by the producer of that product. So how they decide to bundle up different commodities into that index is really at their discretion. And with that comes problems in that we do get this muting of possible outliers, all of those different things. So, yeah, I think it's problematic trading anything that consolidates things together into an instrument, a single instrument to trade.
Thanks.
And as one of the things I brought up in the podcast with the whole group was the idea that why we have the perfect portfolio. We have every market that anybody could ever want at our fingertips. And why anything else? Why add convergent? The S&P investors don't require, it doesn't look like they require any sort of money management. They're not too concerned about a 50% to 90% drawdown. Oh, but we are very concerned by this. So I think delivering returns, consistent returns, that's the real benefit of these long-term trend following systems, is that they make money almost all the time, almost every year. They do have, the drawdowns not nearly as big as the stock drawdowns could possibly be. There's no way a trend follower who trades currencies, commodities, stocks, and bonds, long and short, could be as bad as as the S&P returns in risk, 8% with a more than 50% drawdown. If you're targeting 8%, you might have a 16% or a 24% drawdown trading all these markets. And yet, we don't embrace these single stocks. We don't grab that diversification and the hunt for those outliers and putting together a portfolio of equities because that's what people like. We're just going to trend follow them. It's going to be more diversified. We're going to apply the systems with the vol of that market. We're going to put ourselves in a highly likely position to find some of these outliers in the stocks that we trade. We can't trade them all, but in the same way that we find the outliers in the commodities and currencies and interest rates, we can do the same in stocks. But the CTAs have embraced these indices because they're futures, because everyone does it, because it's a hassle to trade stocks, and then clients are not going to want to do that. They pigeonhole us as futures traders. My biggest client, I went to them in the 90s and said, "Can I trade single stocks?" And they said, "No, you're a futures trader." Single stock futures came out, and I said, "Can I trade single stock futures?" They said, of course, you're a futures trader. So you're dealing with clients who are not trying to pursue the best possible performance. So CTAs have a less than stellar reputation because they don't embrace these equities, and the performance is not going to be as good because they don't embrace the equities. And yet, I think that's my little speech that I gave, I think probably Wednesday as well. That's a real problem for the industry, is to not take advantage of those markets.
I want to tell one story. I had one client this year, and I had near 18% on their account, commodities account. It was near 18%, and this spring, spring of 2021, and he invested money in my account, and when it was 16%, I mean near 2% low than it was, and I said to him how this works. He understood all this. He is not a stupid guy. He is a clever guy from Silicon Valley, and he understood all this. And he said, okay, I understand how it works. I want to play in this game. I want to invest. I don't want to lose money. I have lost money in buy and hold strategy in the crisis 2020. And after that, when he saw 2% drawdown, he said, I don't want to have drawdowns. I don't want to see this. I can't. Psychologically, I can't. And I understood that it's a better way for me to buy SP500, buy and hold. To buy and hold is the best strategy for me because it's more easy in a psychological way. And I said for him, no, I think the better strategy for you is to buy land for farmers. And if crisis, and he said, I don't want to be a farmer. I said, okay, if crisis, massive crisis, will begin, you will, if you don't want to, you will sell this land for farmers for a good price, or organize farm by yourself. And it will be a better decision than to buy SP 500s if you are afraid of trading of the markets. It is a better decision if you have such a psychological issues.
I remember one of my favourites commentators is a bloke called Mark Faber. He produces this doom and gloom report, and I remember back in 2008, it was just before 2008, where things were, the bubble was huge, and a commentator was asking Mark Faber, he said, so Mark, he said, what do you think is the best investment we can take at this particular point in time? And Mark Faber said, in my opinion, he said, the best investment you can do now is buy a farm and buy a large gun. And I remember hearing that and having a good laugh, but I mean, he was so right.
He may have been from Texas. I have Texas friends who swear by all of that, the gun and the large part of land, and then you know the helicopter and the food that can last for years and years. So that's on my list of stocks as well to to research. There's not many gun companies left out there. I don't think, not in the U.S. anyways.
It makes me wonder what's going to happen the next time around we have a major crisis. Like, what opportunities are there now to stem the tide of a major correction like 2008 with all of that quantitative easing? What can they do now? That's what's got me concerned. I'm wondering, are we at the end of days almost with the financial markets? Because I remember in 2008, they were seriously thinking that if they let the markets continue on sort of in an unfettered manner, that could signal systemic collapse of the entire market. So are we in a worse position now in that we don't have the gunpowder left? And, it makes me worry what happens the next time round we have a 50% plunge, then a 60% plunge, an 80% plunge, because people are thinking, oh, too big to fail. Everyone, the central banks are going to step in. But do they have the ammunition left to do anything about it? Or do the markets just shut?
I think that they are following Japan's book, and I think they will start buying equities if something like that happens, because they are doing just what the Japanese did a decade ago or more. At least I think that's what they will start doing.
Yeah, that's a good point. They might have to do something like that, which therefore means maybe 30 or 40 years of just horrible sort of economic symptoms resulting from it. But maybe you're right. Maybe that's what we've got to go through.
And I don't understand how the how it works these days with spending more and more and printing more and more. It doesn't seem to have this negative impact. So I think, do they understand this, or and they just say, let's just keep going because there doesn't seem to be any downside to this. We're getting a bit of inflation, and the bond markets are hanging in there. Like, there's going to be some upside breakouts to some of the bond markets, in a week or so. Probably, it looks like it. So I don't quite understand that, or they're not printing money. I thought they were, but maybe they're not. So I'm confused about how this monetary policy and these all this stuff works these days. It was very simple in the 70s when I was in high school. We printed too much money. It was all inflation is a monetary phenomenon. It's a general rising of all prices. And when you create more demand, we all have more money in our pockets. We are going to spend it and it's going to push prices up. And it's good to have a big mortgage because rates, a fixed mortgage. And so fixed rate mortgage. And so this was perfect. And then 2008, we have to flood the market with lots of money. And this is going to create lots of inflation because, we all lived in the 70s, but it didn't. And so now it's going to create a lot. Now we have this inflation, and it's not just transitory due to the supply chains or whatever. No, we're back to going to pay this price because of the Fed and the monetary policy. And but I don't know. I think it looks like it's sort of short lived. And I'm all for the Fed stepping in and protecting institutions due to a temporary problem with liquidity. Of course, that's kind of their job. But anyways, I can never understand. It's never been explained to me why did Milton Friedman monetary theory all of a sudden, and he's not around anymore, so he can't tell us what's going on today.
Yeah, I tend to agree with you, Jerry. I tend to think back in the sort of the 70s and 80s where things were simpler. I was an accountant back then and things made sense. There was a far better sort of valuation of risk in financial assets and things were far simpler. But the economy's got so obfuscated with these tricks, these window dressing tricks that have sort of kicked the can down the road, that it's so departed from any notion of any fundamental value underlying it. And I think that's what we saw back in the 70s and 80s. There was a far better correlation between the fundamental value and market price. But that is so detached these days that it's almost like this toxic debt fuel binge that has just exacerbated a departure from reality, sacrificing the future generations' prosperity for this sort of hedonistic sort of splurge in the now. And I've got a very nasty feel about what's coming down the track. But as trend followers, we just follow price. It's actually an incredibly ethical profession, our trend following game, because I was thinking we're not sort of the front runners, HFT. We're not sort of exploiting opportunities at the expense of other people. It's a very we play on a very fair, level playing field with our technique. So that gives me a bit of ethical peace of mind that our approach is perhaps the most ethical approach I can see in the trading world.
I just pray we have a market around because, with all these, one of the problems we have is the distance between decisions and actual consequences. So central banks, yes, they're controlling everything, but Jerry made a very good point. Back in the 70s and the 80s, things were a lot more connected. I mean, a central bank could do something, raise rates, and then the following day things were behaving as expected. Now we have so many dimensions. We have derivatives markets, we have unregulated markets, we have onshore, offshore. Everything everything sort of dilutes these actions of central planners. So things become a little bit more complicated, and trying to apply causality is even harder because we have all these layers of complexity, which, again, I agree with Richard. All we should be doing is just follow price. The question is, will we wake up one day and find that futures markets aren't going to be there anymore because one of the big or more of the big clearing houses have gone? I mean, I hope not, but it's not impossible.
By the way, I want to say about central banks, and Nils said very interesting thing, and remember this. said maybe near a year ago, he said that central banks can directly have their influence only on financial instruments. And if we are talking about commodities, I'm talking about commodities today, all our Clubhouse session. But it's important, really important for me, and I think for all people who are involved in trade and investment processes. And I think that if we trade commodities, central banks, they can't influence directly on commodities prices, only indirect direction methods. So we must have commodities in our portfolio. Of course, if we have enough money for trading this.
So the question is, Jerry, are we going to have a trend following session next Friday on Christmas Eve, or what are your thoughts?
That's a good question. Probably, yes. I honestly kept thinking yesterday that I was going to do an impromptu club at Derek's time, and I logged on for like 10 seconds. My good buddy Oleg, I think he was Johnny on the spot, right there with me. I couldn't do it. I think I have one day in me, and I just was feeling too much pressure to perform. What can I say? I spent myself on that on Wednesday. So much anxiety. Rob just caused me so much tension getting ready and having to be at my best. And I don't know if I was, but
You mean Rob Sharp Carver? Did you see how he also changed his name during the session to Rob Volatility Targeting Carver?
he likes to mention me and play up our disagreements. I told him I was just jealous of his humor. As you remember, I did say, yes, I do have to admit that you are very funny. Then Richard comes along, he's equally as funny. So then I'm like really struggling, to up my game on the humor side. But, he does his podcast with Niels and he has to mention me, and I'm choking. I'm telling Alexa to turn Rob off. I'm falling off a treadmill. So he can't live without me, it seems. Um, I don't know if you listened to that podcast, but he came up with a very interesting idea, um, which I had never heard before, but it's definitely worth listening to. And I wanted to get your opinion on it. Hopefully, you've listened to this, but he basically is trying to come up with this method to for traders with small bank accounts, with small trading AUM, to problems with that. You can only do one contract or one share, but maybe your quantity formula is saying, hey, with your AUM and this volatility, you have to do a quarter of a contract, and so you can't do a quarter of a contract. So he came up with this idea, which I thought was amazing. I don't think it works, and for a couple of reasons, but he says it does work. So it basically, he will run the system through the computer, and it comes back with 150 markets. It's 150 markets he wants to trade, and then a lot of them are a third of a contract, a tenth of a contract. So you can't do it. Okay, but he runs it through there. He does the back test, and he says, I tweeted this. It's amazing. I mean, it is miraculous what happens to your performance with 150 markets. Okay, he's been listening to Richard. Exactly. And so then he says, but I only I don't have enough money to do that. So what I'm going to do is I'm going to run this algorithm that is going to analyze my daily positions, let's say, of this theoretical account that trades 150 markets. And I'm going to tell the computer to um, mimic this performance, but you can't use more than like 10 markets. So I thought, oh man, that's amazing. That would be great if it would work. And but I thought that that would be problematic. So he'll say something like, okay, so maybe I have silver, gold, and platinum, and the computer will say, no need to do all three, just do a bit of gold, or just do gold because you can do one contract, but you can't do that in silver and platinum. So it makes these decisions that he can implement. And he says that, for instance, if the 150 market portfolio has a Sharp of 1.5, this algorithm that goes through and tries to mimic that, its Sharp will be 1.4. Okay, so I don't understand how something like that would get around the issue that we're hunting for outliers. Outliers are going to dominate our performance. So you need to trade gold, silver, and platinum, for instance, because one of the three may have an outlier, and you may not have chosen that one. So my conclusion was that exactly that is going to be a major problem that a computer is not going to be able to predict. But if you do things in your portfolio that are convergent things like vol targeting and limiting the size of these outliers essentially in the name of risk control and Sharp, then maybe that would fit in better with something like this because you're trading incorrectly anyways, which makes it easier for the computer to sort of mimic. Does that make sense, Richard?
Yeah, look, I did hear it, and I certainly was nodding my head on it because unfortunately, with us retail traders, we have this finite capital, and so that actually does impose these strict limitations on us as far as how many markets we can diversify into, how many systems we can diversify into. And so his approach is using a comparison between an unfettered, an infinite diversification potential result using all of the available return streams and then evaluating under practical limitations or which are the markets that you can trade in there. So he's using a form of optimization. Your technique in your world, Jerry, would be following that infinite approach. And he's accepting that. He's saying that the infinite approach is best, infinite diversification is best. However, under these practical limitations of retail trading, we've got to make a choice ultimately. So the best way to make a choice is therefore apply an optimization process that from that basket of infinite possibilities, you select those that compile to produce the best risk-adjusted return. So I can see where he's coming from here, and unfortunately, in my process, I've got to do a similar thing as well. So, I have these infinite return streams that I'd love to be able to trade, but I can't in reality. So I can see where he's coming from. I can see why he's applying this optimization approach, but we've got to remember that the better result is this infinite approach. His optimized result should never exceed that infinite approach. I'd argue that when I apply this, I always find that, oh, damn, I'd get a far better risk-adjusted return if I could diversify far more widely. However, the reality is I've got to sacrifice a bit of that for the practical limitations of my finite capital restrictions and my broker limitations. So, um, if we found that his optimized approach exceeded the result of that infinite diversification, I'd be yelling out, watch out for curve fitting or fit optimizations. But provided it is within that sort of logical space that doesn't exceed that infinite potential, I can see merit in what he's doing and I can understand why he's doing it.
Oh yeah, I definitely understand why. I just wonder if it really works with the idea that I laid out, that it might work better if you're not letting profits run to the max. And that would fit his idea because he doesn't really want to do that without some risk management on the open trade. So, but I thought it was very interesting.
Yeah, I
And
agree. If we can expel all the convergent demons from Rob and say, Rob, do this, but with a fully divergent method that is a classic trend following method, I'm on board with your process, Rob. However, get rid of those convergent tricks up your sleeve.
but the convergent piece is what makes it likely to work, and it probably won't work if the computer says, okay, no reason to buy platinum and silver and gold. Just do one of those three. But the computer is not aware that it's going to run into trouble if the one that he doesn't trade has the big outlier move.
Yeah, definitely. That convergent piece, if he puts a convergent piece in there, he's going to find that his returns actually exceed that of his infinite divergent model. And this is where overfitting comes in, because through the method of convergence, you're basically tailoring your system to the a particular market regime, which therefore achieves fantastic performance over these favourable market regimes. It's the unfavourable regimes where the negative skew is exposed in these things. And if you apply doubling convergence, you ultimately instill negative skew into your portfolio, and that's where all the trouble begins. And as we see, that is, this warehousing risk in the portfolio builds up, and suddenly you find you've got a minefield on your hand.
In the last few minutes of the meeting, does anybody who hasn't spoken, especially, want to bring up a question or another topic to the last 10 minutes?
I don't have anything particular. I'm just looking forward to the episode, the next episode, on Top Traders Unplugged. But yeah.
Lulu, how's your Ed Sakota trading tribe going?
Hi, Richard. Doing great, doing great. So I want to segue what Jerry's concern about the Fed's money printing. I think I learned a theory about shadow banking. Have you heard of that?
No.
No, go ahead.
Just to do some research about shadow banking. I mean, I'm not articulate enough, but it's called shadow banking. So it's not money printing. Yeah, I don't know much. I just threw it there.
Shadow banking refers to anything that is operating like a bank, but in the shadow of a central bank. So it's unregulated credit extension. Anything from derivatives market to all these platforms where you do crowdfunding and these kind of things. So all credit extension that happens without the explicit control of a central bank. And the biggest shadow banking market perhaps is the Eurodollar market and all the offshore offshore interest rate markets. And we have all these short-term interest rate futures are a prime example of shadow banking and what problems it can create when it goes unhinged.
Yeah, thanks, Bruno.
Bruno, don't you think that you said that now the system is much more complicated than it used to be in the 70s, etc. But don't you think that the main complexity or the main game changer is that people are not managing their money by themselves, but they are giving them to pension funds and index funds and people that have billions and billions of assets under management, but they don't have the direct responsibility of facing the client, since the client is very, very far away in the chain of responsibility.
Well, I wish I had an answer. It's one of the few things I don't have much of an opinion on. I don't know. It's a good idea, but I have no idea why the system got so complex as it is now from where we started. I think technology plays a role, and things that now are more sort of pushed down to away from the hands of decision makers into other agents. But I really have no idea whether, as you said, the answer is because of all this disintermediation that is going on, or whether it's it's something else. I wouldn't be able to tell. All I'm saying is that there's a lot of different places other than central bank decisions where a lot of the financial consequences of monetary and fiscal policies are felt and probably even created. And and for us, it's difficult to keep track of everything.
It's interesting. When you take the history of the S&P 500, for instance, you see that from the 1950s right up till around about 2002, divergent strategies dominated. Mean reversion, if you applied mean reversion during that 50, 60-year regime, you'd have been sunk out the back door. However, there has been this growth, this plethora of convergence that has, I think, is simultaneously linked to regulatory intervention. Because if we can imagine, post 2008, the amount of quantitative easing that occurred, and the central bank policies basically gave a predictable environment where you knew that you'd be fairly safe in buying the dips and selling the tips. And it's interesting that in around about 2009, we saw this explosion of high frequency trading, which is capitalizing on this very short-term phenomena. It's explicitly attacking convergent opportunities. You don't find many HFT traders applying divergence. It's dominated by convergence, and we've had this sort of almost this explosion of this participant mix being dominated by convergence. And now, what previously was a participant mix for 50, 60 years, that might have been, 60% convergence, 40% divergence. We're now seeing the participant mix is about 95% convergence and 5% divergence. So it's just interesting that the participant mix has changed, and therefore the overall behaviour of the market has changed, the market behaviour from the interactions that occur between this explosion of convergence and the participant mix. It's fundamentally, I think, changed the nature of the market over this period of intervention. So the question then comes, well, what happens if this period of intervention is relaxed? Do we revert back to the traditional regime of where divergence has a much greater say in the matter, where markets can transition to new equilibrium, find their more stable spot, because at the moment it appears that markets are so sort of disparate from any notion of an equilibrium or a stability, with this period, that you start thinking, well, can this sort of dominance of mean reversion persist? And we certainly, in the last 12 months, we've seen divergence explode, with the classic trend followers getting their best returns they've ever had. And it's sort of this period of suppression that's occurred up until about 2020, and now the shackles are being released, and we're seeing the markets finally start perhaps moving towards a more, more stable, well, fundamentally relevant regime than they currently are. So I'd be interested to see how it all plays out.
And the subsequent tremendous underperformance by a lot of the larger CTAs that have adopted the convergent, trying to merge in some of the convergent ideas into their trend following to make it more palatable, more sharpy. And then we have Winton coming back to trend following. Although I don't believe it, I don't really know what they even mean by that. But we'll see. I was in David Harding's office one time, and I was talking to him, and he was telling me about his obsession with trying to figure out how everyone traded. So he would set his computers up to try to say, okay, I want to try to figure out how Chesapeake does it. And I think he wanted to do that with everyone. And then, of course, his love of research and doing things other than trend following. And I was like, well, if trend following doesn't work, I will retire. I have no interest, no intention of doing anything but this. It's great, it's wonderful, and some form of taking small losses and letting profits run and being incredibly diversified. I'm an accountant as well, and I need to be safe. And he was shocked. He was shocked by this. Like, what? Don't you get this enjoyment out of finding something new and better? And well, kind of, yeah, sure, but it has to fit those required ideas of mine of safety, and I unfortunately, I guess, get a lot of fun out of continuing to talk about the same things and learn and go to a deeper level on some of these issues, which this club has really helped me recently to refine what I believe, and um, it's very rewarding. But that said, I'm going to sign off and go enjoy the rest of this trading day for me, and we'll plan on meeting on the same time in a week, Christmas Eve. And if not, which I'm pretty sure we will, I'll let everybody know. But thanks again for everybody being here and contributing. And Merry Christmas.
Thanks
Merry
very much.
Christmas, everyone. Thanks very much. Bye,
Thank
Jerry.
you.
Bye.
Same to you.
Thank
Bye,
you.
guys.
Bye.